IPOs show crypto is growing up. Bitcoin and other cryptocurrencies have long existed on the edges of global finance, occupying a strange parallel universe. For many in markets, they probably resembled the Wild West. Now, with IPOs and traditional trading venues opening up, it seems that the industry is becoming a little more refined. Coinbase, the biggest US crypto trading venue, has launched its IPO, which is perhaps the biggest development in the space since Satoshi Nakamoto wrote his white paper. The listing democratizes a key part of the infrastructure and gives more risk-averse and fundamental investors a way to value and profit from new technology. Think of this IPO as selling shovels in a gold rush. Investing in an exchange doesn't require the belief that crypto will replace the dollar. As long as there are those who are willing to buy and trade crypto, volume at this new class of exchange should do well. Beyond Coinbase's pure size, though, what makes it significant for investors is that it offers a way of applying the methods of traditional finance to crypto. Discount cash flow models don't work on quasi-currencies that pay no yield and rely on the greater fool theory of investing. The old Gordon growth model can easily be applied to the business of an exchange, though, as can free cash flow models, residual income models, PE and PEG ratios, and the whole panoply of tools equity analysts have developed over the years. Of course, those same valuation metrics may show that Coinbase is significantly more than fairly valued. And yes, listings like these run somewhat contrary to the non-conformist spirit of crypto. Bitcoin promised a new decentralized world order, where sovereign individuals transact directly with one another without the need for intermediaries like banks, exchanges, and clearinghouses. Instead, the most lucrative crypto-related companies are those that provide financial services. In fact, it's perhaps a little ironic that for an asset class that promised to do away with intermediaries, financial exchanges have been among the biggest winners. In the early days, these operated in a regulation vacuum. Nobody knew what these assets were, and anyway, they were too small for regulators to bother with. So predictably, they were high-profile failures. For the most part, though, the industry seems to be shaking off those uncertain beginnings, and names like Binance, Kraken, and Bitfinex now trade billions in digital assets every day. There may soon be more IPOs in this space. A play on exchanges and other trading infrastructure might give the investor a buffer against volatility. Whether Bitcoin, Ethereum, and Dogecoin rallies or plunges, trading activity is likely to be robust. It only tends to fall in periods of price stability. And this second layer exposure also removes some of the risk of betting on the wrong horse. Who knows if crypto products Cardano, Polkadot Coin, or Tron end up the eventual winner? Yet it's reasonable to assume they'll all rely on the same trading venues as the current crop. Of course, these investments don't come without risks. The regulation issue remains unsettled, and the future may bring consolidation and more high-profile failures, as well as trading fee price wars. Meanwhile, existing non-crypto exchanges are starting to have a look. CME, which offers contracts in FX, commodities, and fixed income, has launched its own suite of cryptocurrency derivatives. And there's always the chance that Bitcoin will go back to its roots, with transactions across oceans taking place directly between sovereign individuals. I'm Eddie van der Walt. This is Decrypted. For more content like this, follow us on your favorite platforms.
Don't forget to like and subscribe.